Let's bring the conversation back home now, and the big supermarkets put out their final quarter figures this week. Wesfarmers, through its Coles chain, is seen as winning the growth game, but on the market over the past 12 months or so, it's only just outperforming Woolies. The real outperformance is against their suppliers. Goodman Fielder, a big supplier of bread and spreads, is really suffering. It put out yet another glum earnings warning and had another round of asset write-downs this week. And Tom, Goodman Fielder, in the same situation many suppliers, many smaller competitors are in when it comes to going up against the big two.
Well, look, Goodman Fielder gets it at both ends. I mean, their input costs are going up, grains, oils, that sort of thing. They make bread and margarine and things like that. And on the other hand, the big supermarkets are pushing very, very hard to lower prices, to reintroduce more home brands and so forth. So for a company like Goodman's that's caught in the middle, it's a very, very tough time right now.
And they're also, sorry, they're not really responding in a way to customer demand. There's shifting demand over to those sort of artisanal breads that are, the $7 loaves that people are, buying at the moment.
Yeah. So another example to be careful not to buy things from private equities when they sell them.
Yes, lots of red flags there. Now, you've been charting the whole Wesfarmers financial outlook up since they took over Coles.
Yes, so we've got a chart right here actually, and what this is showing is that in 2007 when they made their acquisition, you can see there's a big spike in the grey bars, which is the equity. So the company's raised a lot of equity to make that acquisition. It's also raised a lot of debt. The debt's much higher as well, which are the red bars. But the impact of that increase in equity without a commensurate increase in profit means return on equity is slumped. And that's what the share price is going to follow over long periods of time. What I can share with you now is that since 2007 the company's raised about $22 billion, but their profits have only gone up $1.1 billion. So the money that they've raised, that incremental capital, they've only generated a return of 5%. Which is less than what you can get in a bank account.
Well, Wesfarmers was always known as being a very good manager of money, because really it's an investment business.
It was always return on equity based. Remuneration was return on equity based. And now what you're doing is, I can give me $22 billion and I'll stick it in the bank, and for no risk. Yeah, well, Tom's got it. But I'll stick it in the bank, and the only infrastructure I need is a rocking chair to get a similar rate of return. We're paying the managers of these companies millions and millions of dollars to generate a return that's less than what you can get at arguably risk-free. And so my suggestion is that really their remuneration should be based on what they generate in excess of that number. They're only getting 5%. You can get 5% at a bank if they can get their cost of capital, which they're clearly not. Wesfarmers has come out and said their cost of debt is about 8%. Yeah. Their cost of equity is something more than that. They're not maintaining it. Why are we paying them so much?
And Jo, you think they should be marked down accordingly?
Well, I think, and the outlook doesn't look so great. I mean, I think we knew that they were going to take a huge hit on ROE when they bought Coles for some time. The question is, when does it start earning, those amounts to push up the ROE? But the outlook from Richard Goyder, I mean, I heard he was talking this week, during the week, about sales and margins. He said, we're going for volume growth. We can't worry about margins.
It's
not about margin
That's
anymore.
all it's about.
So
that's all about.
I don't know where
if your
the upside
salary
is
is pegged to earnings growth and revenue growth, then that's all you care about.
Yeah.
But if your earnings are pegged to profitability, there's an opportunity cost while people wait for that to pick up.
Yeah.
I must say, I do remember the day they did the deal with Coles, and there was no. I remember people thought there'd be another buyer. I spoke to a stockbroker and he said, you know what? I think Wesfarmers share price is going down as of today, and the stock was about $45, $46
$44.
Then.
Yeah. That's right.
And it hit a low of 13 during the GFC.